Hi everyone. We just finished calculating the second quarter performance metrics for the major property types. This week I'm going to do a quick performance rundown for hotels, apartments, and office properties. So the underlying demand drivers for all of the property types is pretty much positive. We've added about 1 million new jobs in the first half of this year, and the unemployment rate is at about 3.7%, which is very low. There are some headwinds, of course, the trade war, what's been happening with interest rates and the roller coaster of ups and downs that they've been going through, but there's no significant setbacks on the radar screen. Starting with hotels, the key drivers of hotel demand include business travel, which is supported by corporate profits, which are at an all-time high, up 7% from last year. The strong employment and wage growth is also supporting leisure travel, so hotel occupancy is holding strong at about 66.2% on an annualized basis. Basically, we've been at record occupancy levels for hotels for more than a year. The annualized average daily rate, or ADR, growth has been tapering though. Now it's at about 1.7%, and last year at this time it was about 2.3%. There's exceptional performance, but the ability to move rents is getting more challenging. Overall, the hotel sector is sustaining record performance, but the growth curve is flattening. Now for apartments, the strong hiring over the last several years combined with low unemployment is unlocking household formation. For example, the unemployment rate for people with a high school diploma or less is at about 4.2%. That's exceptionally low. Remember that it peaked at 12% in 2009. So basically, the economy is at full employment, which is allowing people who have a difficult time finding jobs to get employment and move out on their own, creating apartment demand. Now, apartment absorption in the second quarter surged to 182,000 net new units. That's the strongest quarter on record, going all the way back to the early 90s. Vacancy went down in the second quarter to 4.1%. That's the lowest quarterly vacancy rate since 2001. And that's supporting a solid 4.7% rent growth. Overall, apartments are sustaining record performance. The office sector is also benefiting from strong corporate profits and job creation, but not getting as much lift as we're seeing in apartments. Absorption is running around 85 to 90 million square feet per year for the last 5 years, but construction is finally starting to catch up. That kept the second quarter vacancy stable at 13.2%, and that's on par with pre-recession levels. Rent growth is in about the 2.5% range. So overall, demand is pacing new supply on a macro level for office properties, but there's significant variance on a local level, which creates a variety of opportunities. In conclusion, all property types are sustaining a positive outlook that is at or near record performance levels. The economy continues to drive performance, and although there are some risks, the Fed rate cut will give the economy a boost and extend this cycle. The construction pipeline for all property types is beginning to taper, market liquidity is very good, and underwriting has been solid. The commercial real estate investment outlook remains very positive.